If you're a professional investor and you're doing private placement and you're buying an office building or you're buying a multifamily, you make a purchase with 30% down. You get a group of investors, each one's got X amount of shares in the LLC. Excuse me, you buy it for $10 million and you get 30% down, you get a $7 million loan. Well, then you do value add. You go in and clean up the project. You put in new landscaping, you paint it, you clean it, you put in new countertops, new appliances, and then you raise the rents. And then you go and get it reappraised and refinanced. So this $10 million property, which now had value add, is now worth $13 million, maybe $14 million. And you take 70% out for the new loan. Well, so now the new loan is like $10.5 million.
Okay, I got it.
So all the investors have their money.
Yeah. Okay. I get that, and that's a fairly common real estate strategy, right? You build it up, you add value.
The problem, of course, now is where are you in the cycle? Right?
Well, yeah. Well, now we're in a cycle where all these buildings are falling in value. And what do you do then? If you own something that's $100 million or was $100 million and now it's maybe 45, you just default, it sounds like.
So if you've done infinite returns, you've got all your investors' money out, who have you shifted the risk to?
The bank. There's our segue into what comes next, because these local and regional banks own all this paper.
Yeah, that's exactly correct. So brilliant strategy. So all that you really got to lose is the profit, and then you put it onto the banks. And then the question then becomes, if you're doing a tower, it's typically there's multiple lenders on the tower. You got a 40, 50 story building that maybe this building is $200 million. And maybe you got 4 institutions putting $50 million in. The other institutions are going to be insurance companies and pension funds.
And that's all out there waiting to happen, right? Is that a this year story from your point of view?
I think it's going right now. From the data I see, there's a billion, not a million, a billion square feet of vacant office space in the U.S. right now. And we're adding to it. New York in Manhattan, mid-Manhattan, they've got high rises that are being completed. It takes 2 or 3 years, John, for these things to get completed. 2 years ago, it was a great idea to be bringing office space to you. And now 3 years later, when it's completing, not such a good idea.
Yeah.
So this is a contagion. So this is going on now. And what I'd like to ask you is what your thoughts are, because not only are the banks involved in this strategy, because the banks, a lot of these loans were non-recourse. So if they go bad, they go bad. And so the investors have all their money. They have no obligation to the building. And the risk management for these places, what are you thinking?
Well, I think the banks are going to have to eat a bunch of losses. See, those are the kind of deals that get done when money is easy and banks are competing for business. So they'll do the non-recourse. They'll do whatever to get the deal done because they want the fees. And then it comes back to bite them. And this has happened, well, in the time I've been paying attention, at least 3 times in the real estate industry where,
number 4 for me. This will be the 4th cycle. Yep. They all seem to be the same. They got the same texture, it just unfolds. It's just pretty weird. And the problem from my end is the amount of liquidity that gets put out. The banks get this liquidity and they have to do something with it, right? And the more liquidity there is, the more stupid things they do.
Well, because if you're a banker, you can't just sit on that cash, because the aggressive bankers make way more money than you do. And then your board fires you and replaces you with one of the bankers that are just willing to do any deal. Basically, that saying for that is that bad bankers chase good bankers out of the business during easy money times. Yeah.
And then, of course, not only do they get the returns, they're getting fees and they're getting rich on this.
The fees are the thing, because the bankers are looking a year or two ahead, right? They're looking at next year's year-end bonus, which is based in part on the fees and things like that. And that's especially because bank CEOs tend to skew older. They're 50s and 60-year-old guys. So they're not going to be around that much longer. So next year's bonus is a huge deal for them.
This segues right into the fact, who do they partner up with in order to get these big towers financed? And that would be insurance companies and life insurance, annuity insurance, and healthcare. They have a burn rate. So they have to keep replacing this money that they're burning through, because they're paying out claims. And so they get insurance companies, and then they also partner with pension funds. And pension funds have a burn rate. So when you start thinking of banks want collateral. So what's the best collateral for a bank? Is some kind of treasury, right?
Yeah, banks own a ton of treasuries now, apparently.
And this is collateral, so they can trade these among each other, and they pledge this collateral. And what happened to that collateral?
Well, bonds had one of the worst 2-year stretches in history just lately. So that there was all this unreported losses on bank balance sheets.
That's really what I want to talk to you about, was just this infinite strategy and a transfer of risk from the investors, which is really clever. I mean, really, really clever to do that. And then to the banks, but not only the banks, but the pension funds and the insurance companies. And so the banks have had this enormous losses that they haven't, as you say, they haven't realized. But I'm hearing it's $600 billion.
Yeah, that's about right. So basically what happens is people get nervous about the local and regional banks because there are rumors that there's trouble there. And then depositors pull their money out, which forces the bank to sell some of their assets, even though those assets are underwater, in order to pay off the depositors. Then they have to report that loss, which spooks even more depositors, and so on until you get a bank run. And then one bank spreads to another bank. And there are, how many small banks are there out there? Something like 3,000. There's a big number. So you get a massive, like kind of a brush fire of banks maybe failing because their depositors are pulling out. And then the federal government has to step in and bail them out, which is kind of the end game from my point of view. Because remember, I had a website called dollarcollapse.com for all those years. And so the final stage of the process, when governments are bailing out everybody in sight, and that shifts the pressure over to the currency, is, I think, where the rubber meets the road. That's where the system starts to break down, because if you don't have a functioning currency, then all your monetary tools don't work anymore. And if you've got a massive amount of bad debt and you don't have any monetary tools left, then you get something really extreme happening. And that's kind of what we're headed for, one way or another. It's a timing question. But as you said, a lot of this stuff is maybe a this year story. The commercial real estate thing is just right there waiting to happen, or it is happening, but it hasn't hit the front pages of newspapers yet. And when that does, then that becomes maybe this cycle's subprime mortgages. The thing that blows up first, it starts knocking down other dominoes and starts the whole process rolling downhill. So, it could well be that what you and I are talking about now is the thing that defines the bursting of the coming, or of today's bubble.
Well, my concern is not only the banks, because you've outlined exactly what's going to happen. They're going to go from a solvent to insolvent, and that can happen reasonably quickly. Is that they partner with the pension funds, and of course the baby boomers are retiring. They're no longer adding to the system; they're subtracting to the system, and they have benefits with these pension funds. And of course, the pension funds are taking losses. So. I'm told that CalPERS has $50 billion of exposure to commercial real estate, a lot of it in San Francisco. Well,
it's just one more aspect of how badly run California is, because one badly run institution is now suffering because of another badly run institution. And it's just going to go on and on for them. Remember, California, because Silicon Valley is there, makes an awful lot of their tax revenues from capital gains when IPOs happen and when startup companies get funded. And if we have an equities bear market, along with the banking crisis and the CRE crisis and everything, then that kicks one of the stools out from under California. And they already are running, a $68 billion deficit this year? And that is with an equities bull market. So they're probably still making capital gains money with all the AI stuff that's going on. So you take that away, and 68 billion might become 100 billion. And for a state, not for the federal government, for a state, when you start looking for catalysts for the next crisis, one thing kind of runs into the next thing, and it's like this infinite loop of, oh, this could go bad and it'll cause this to go bad, and it just goes on and on. So there's no real way to know where in the loop that we're going to come in, like what the first thing will be, but they're all connected. Once one thing blows up, the rest of them will go in fairly short order, until we're out there with a currency crisis, with the dollar plunging in value, and us talking about the monetary reset and the gold standard and things like that. Well, you can make the case that the system basically blew up in 2000 when the tech stock bubble burst, and that everything since then has been on literally borrowed time. We've just been borrowing insane amounts of money and keeping interest rates artificially low in order to facilitate borrowing of infinite amounts of money. And that's what got us through the ensuing 25 years, but it was all borrowed. It was all fake. So, I guess my thought is, let's just get it over with. There's nowhere to go from here except that eventual currency reset. So let's just do it. I don't think we're that far from that now with CRE doing what it's doing, and so many other aspects of a debt bubble out there that are, right on the edge. Oh, the U.S. government, speaking of debt bubbles, we're going to sell $10 trillion of treasury paper this year, because we've got $1.5 trillion deficit, and we've got 8.5 trillion of existing paper that has to be rolled over, all now at higher interest rates because the Fed isn't cutting rates after all. That's going to increase the government's interest cost to $1.5 trillion a year. Just on the debt, we're running $1.5 trillion deficit, leaving everything else aside just to pay the interest on our bonds. That's a death spiral number there. So there's that too. There's just so many things that are going wrong in a catastrophic way right now, and it's all being papered over by, first of all, massive government deficits, which are stimulative, and this tech bubble that we've got going on out there. All of a sudden, AI has replaced .coms and given us a new tech bubble that creates the illusion of excitement and prosperity. But it's completely fake. There are a handful of companies that are doing really well, but the vast majority of the companies in the S&P 500 are not doing nearly as well, and the vast majority of stocks in the S&P 500 are not up in the past year. We would have a bear market in equities if we just took the top 10 stocks out of the S&P 500. So,
and the Russell is 40% of the Russell are not making enough money. And I think these are, you consider them zombie companies, do you not? And they've got $2 trillion of triple B that needs to be replaced this year too, on top of the government. So where's all this liquidity going to come from to do all this? It's all at higher rates and at higher risk. Where's the liquidity coming from?
Well, right now you've got the U.S. government running $1.5 trillion a year deficits, which is very stimulative. That's, by definition, that's just them creating money out of thin air and tossing it into the banking system. So that's very stimulative. They call that fiscal dominance now. Now, monetary policy is not stimulative, but fiscal policy is extremely stimulative. And so the government spending and borrowing side of the equation is what's dominant in the economy now. But again, unsustainable, because we're having to pay interest on the new money we borrow each year, which forces us to borrow even more. So we're in basically a self-reinforcing feedback loop that's taking us off a financial cliff, because we're already over indebted to the point where we're never going to be able to pay off the debt that we've taken on so far. But now we're borrowing more at an accelerating rate as interest costs spiral out of control. And there's no solution for any of this. We're just in a place that precedes a gigantic crisis of some sort. And it doesn't seem that bad to an awful lot of people. People who are looking at the NASDAQ and looking at what they would have made if they bought more in NVIDIA stock, they don't get the sense that the world is coming to an end, the world as we know it. But it is, the financial world is totally broken. And a tech stock bubble does not fix that in any way.
It seems to me, just looking out, I'm not an equity guy, but we had all this liquidity. I went into the Federal Reserve electronic data system last week, and I stumbled into the M1 money supply. And when we went into that in the COVID crisis, we put $14 trillion in liquidity into M1 in 1 month.
Yeah.
And so what do you think is going to happen when you do that? So we've had the bond bubble burst. We have the real estate bubble, which is bursting right now. That's underway. And then you've got the stock bubble all this liquidity went into these three asset classes, other asset classes, but those are the three majors. So the question then becomes, what's going to happen when we have this equity problem? Because you mentioned it already, it's the third leg of the stool that's going to have problems to it. Where do we go from there? Because I think that the administration is gaming the system. They're gaming the GDP by adding, they're running like a 5% deficit or a 6% deficit, and we're only at a 3.5% GDP. So if we took that out, we'd be at a negative 2.5. We'd be negative without that. I think that they're like a MMT type of thought process, modern monetary theory, where they just create this money and nothing's going to happen. But obviously things do. So their policy response has always been, let's put $15 trillion in. Next time they're probably going to have to put $30 trillion in. What does that do to the dollar, John? What happens to the dollar, and what assets survive when you have this kind of liquidity that gets pushed into the system?
Well, people stop wanting to hold the currency of a country that's doing that. So in our case, that means Americans, when they get paid and they have a little money left over, they immediately convert it into real assets like gold and silver coins, or some kind of real estate, or anything basically real that governments can't just create out of thin air. That's called a crack up boom, because that rise in demand for real stuff sends the prices of those real things through the roof, which is inflation, right? When prices are going up. Mm-hmm. Right. So you get rising inflation. And we already got a glimpse of that in 2022, when we had something like 8.5% official inflation and much higher inflation for a lot of people, depending on the mix of things they buy. So we found out what happens when you increase the money supply by 40%, and it's a spike in inflation. So soon we'll find out what happens when you bail out $10 trillion worth of bad financial debt out there with newly created currency, which will increase the money supply by, that amount again. It won't be good for the dollar. The dollar's value will start to fall. And so when you reach a point where we have something like that happen and you cannot stop it. In other words, let's say interest rates are already so high that were you to raise interest rates higher to protect the dollar, you would bankrupt all kinds of leveraged speculators out there. Right. Can't handle higher interest rates. And if they blow up, you have to bail them out with newly created currency, which makes the dollar go down even harder. And so you're in that kind of a cycle and you can't get out of it. And that I think is what people should be concerned about going forward, because that's a real thing. That's the kind of thing that historically has happened over and over again. There's nothing mystical, magical about hyperinflations. Countries have screwed up their currencies multiple times throughout history. Just Google list of hyperinflations, and you get a whole page of names of name brand countries that have destroyed their currencies by doing what we're doing now. So we're not immune to those basic laws of finance. We're just bigger and much more solid than any of those countries in the past. So it's taking longer for what's coming to come, but it can't be stopped. Once you've borrowed too much money, you have a consequence, and you have to deal with that consequence somehow.
John, can you maybe put this down into a scenario? Because it's going to collapse. My thing is going to collapse. We're going to have deflation. We're going to see all this default just because it's not sustainable. If you raise interest rates on a vacant office building and refinance, there's no income. So what's an asset worth that's being sold on income when there's no income? The value drops precipitously. How does that scenario play out in your mind?
Falling real estate prices, as we're seeing now in commercial real estate, that's deflationary. So that, other things being equal, that would pull price levels down. But in a highly leveraged system, you can't have prices falling, because you need a certain amount of inflation to kind of lubricate all that debt that's out there. Because paying back debt in a depreciated currency is easier than paying it back in a currency that's getting more valuable. So if you allow the value of your currency to go up, which is to say you allow the price of a bunch of things to fall, then that means a bunch of debt can't be managed, that might otherwise be able to be sustained, and they go bankrupt too, which is also deflationary. So you get a real deflationary crisis. That's what happened in the 1930s. We had a stock market crash, which was deflationary, and then the economy just imploded, and the dollar went up in value during the 1930s. So we had deflation, which was a rising currency value, and we basically had to enter World War II to get us out of that depression. And the guys at the Fed know that. And they don't want to be the people who preside over us tipping into a 1930s style deflationary depression.
Ooh, yeah, that'd be
So,
brutal.
so they want to bail out the bad debt when it happens, when it starts to go bad publicly. So when commercial real estate really starts to fall apart, and that affects the banks, and that in turn affects the insurance companies and the pension funds, government has to step in and bail them out. And we're talking $10 trillion when you add all those guys up together. So it's going to be very big numbers, and it's going to be very scary for anybody who's thinking about what that does to the currency. So, Michael, I would have said all of this 5 years ago. So the timing of this is really, it's a very hard call. And the reason that maybe we can talk about it being imminent is because we've got a thing blowing up right now. Commercial real estate is actually starting to fall apart. And so maybe that's the subprime mortgage bust that set off everything else in 2007 and then gave us a really deep recession in 2009. Maybe we're there again. I wouldn't want to say for certain that that's a 2024 story, but there are things happening that kind of point in that direction. So we should be very aware of the possibility of something like that happening in the short run.
The third leg of the stool is the equities. They really, so in the prior real estate cycle in the 80s, 87, 88, 89, that's when commercial led the way. Commercial went down first, and then in the 90s, late 89 and early 90, you had a lot of residential come down. And of course, then the next cycle, it was residential that led the way. This way is commercial that's leading the way in the real estate cycle. But on top of that, we had all this liquidity that went into the markets, into bonds, stocks, and real estate. And now we're told that the Russell, 40% of those firms in the Russell 2000 aren't making any profit. And it seems to me that's the other leg of the stool. So if you've got $2 trillion worth of triple B for companies that are zombies, and these zombie companies employ 10 million people, I think that's the number that's being thrown. Maybe it's 12 million people. They employ a lot of people, and these people can't. If those zombie companies can no longer get financing, they're out of business. So that'd be all three legs of the stool gone at the same time. So the policy responses from what you're saying is they're just going to throw money at it. Huge numbers of dollars. Mind-boggling. 20, 30, 40 trillion dollars.
Well, they'll see that as their only option, because if they let it continue, if they let all the bad debt blow up, and one of the things that feeds into the small business story is the problem with the local and regional banks, because they've got this portfolio of government bonds, which are way down, and commercial real estate, which are falling apart basically in a lot of cases, and that has led them to tighten their lending standards. Because they're scared, so they require a lot more from a credit from one of their customers in order to be able to justify lending to them now. And that's small businesses that you're talking about there. They're having trouble getting by right now based just on what they're making from their customers and what they're paying their employees, but they can't really borrow any money to do anything about it because the banks don't want to hear about it right now. They don't want to lend them any money. So they're kind of in a bind where wage costs are up, demand for whatever it is they're selling is okay, but not good enough to really turn a serious profit. And they could invest in new capital equipment, but to get that loan, they have to show better numbers than they're generating to their banks. So nobody's going to lend any money to them. So they're in a box. And it's not really clear what helps them because, money has to stay, even if the Fed starts easing a little bit right now, monetary policy has to stay tight for a while. And just the Fed not tightening anymore doesn't make monetary policy automatically loose. It just means it isn't getting any more tight from where it is. And it's pretty tight right now. So this is looking like a really tough year for a lot of small businesses and not a year that's going to get any better going forward because the banks have to resolve their issues first, and they haven't even begun to do that because the commercial real estate hasn't begun to collapse yet. You're seeing, a building here and a building there that gets some press because it was sold for half of what it was sold for in 2018. There are stories like that out there, but there's nothing really apocalyptic yet. And real estate crises generally become apocalyptic before they start to get better. So yeah, lots of stuff happening, no solutions in sight.
So does that leave us an opportunity? To us, it's time. We're all about timing. So right at the moment, we are just so conservative. We're just holding on to our cash because I think anything that you buy now is at risk. But that doesn't seem like that's going to be the case. If we have a significant drop in prices, that's going to scare the government, and the government response is to throw money at it, which then becomes inflationary. So it seems like there's going to be a time frame where you want to take your cash and deploy that and then ride the inflationary wave. Am I thinking properly here?
Yeah, at some point it makes sense to start borrowing super cheap money again. But we're nowhere near that. I mean, if they push interest rates down into negative territory and someone will lend you money at 0% or negative 0.5% or something like that, then there's a value proposition out there for a lot of real estate. But I think with today's mortgages at 7% and with commercial real estate heading south rather than north, I would agree with you. Just have cash. Look at what Warren Buffett is doing. I think he's got something like $168 billion of cash sitting on the balance sheet of Berkshire Hathaway. If he thought there were a lot of good things to buy out there, he would be buying them hand over fist right now with all that money that he's got sitting there, not yielding him very much. But he's not doing it. He's building a huge cash hoard with the idea that things will get cheaper at some point, and then he'll step back in and he'll buy good businesses for pennies on the dollar. And that is probably the right attitude. Now the question is, do you want to short on the way down? Because that's where people in the Great Recession, that's where the money was made during 2007, 2008, 2009, was by shorting the hell out of everything related to housing and real estate and banking. Completely possible that something like that is coming again. Another financial crisis involving a lot of bad paper, involving the banks, involving the derivatives of the banks, things like that, and that there are a lot of short candidates because of that. In other words, you want to be shorting the local and regional banks. There's a ETF that lets you do that, and you can buy an put option on that ETF so that if banks go down, you make money. And so the question is, how aggressively would we want to do that? I'm doing it a little bit, and it absolutely has not worked out yet. Probably now would be a much better time to do it than when I did it 6 months ago or whatever. But I'm thinking about doing it more because if you get it right, if you call the bursting of a bubble with the right short strategy, you make 5 or 10 times your money in a very short amount of time.
What a great hedging strategy that would be for someone to if they've got assets that really are pretty fixed that you can't really move around. If you've got a big office building and you've got people in there 5 and 10 years, it's pretty hard to sell these things at time. For us in our properties, we have leases that we have families in there. But if you did your hedging strategy, I think Lennar and Toll Brothers are at pretty high values at the moment. They'd be, I would think, would you think they'd be a good strategy to take puts on that?
Well, pull up a chart of Lennar and D.R. Horton. Those two.
Sure. Yeah.
And look what they did between 2006 and 2011. They went down by 90%.
Really?
So they just tanked. Yeah. And so, from here, it's completely conceivable that something like that could happen again. The housing market isn't really the same kind of bubble. There's not a frenzy going on out there. There's just nobody selling and a bunch of hedge funds in there buying with cash to keep prices elevated to levels that are completely unaffordable to normal people. Okay, that's a recipe for a bubble bursting, but it's not that same kind of frenzy that we had in 2005, 2006. So it's not exactly the same thing, but it's completely conceivable that from here, the local and regional banks and the home builders just get whacked. We really need house prices to go down by 40% to
Yes.
bring them back into affordability where the average person can buy the average house, because that's where things bottom, and then house prices and the housing cycle, they top out when the average person can no longer buy anything close to the average house. And we're
Right.
definitely there right now. If you have to
Yeah.
borrow 7% on a mortgage to buy one of today's houses, you're not getting much for your money.
Well, not
And
only has interest rates gone up,
yeah,
but the price of the house has gone up. So it's a double whammy. So when you raise the interest rates, the prices of the houses don't have to go up anymore to decrease the affordability. I mean, it's pretty big. We have a huge demand for housing, and we're short housing all across. But we have an affordability problem. Is that you can build all these expensive homes, and if nobody can buy them, you've got a problem because most people cannot buy them. You're exactly correct, John. So John, let me just tout you a little bit. This is such great information for people. I mean, to give them ideas that you could do this just by you thinking of where we are in the economy, what is going to happen, and putting it in historical context and trying to make that advantageous for yourself. This is just wonderful, wonderful information for people. So they need to follow you. So we've been running your Substack. Where can they get hold of you, John?
I'm at rubino.substack.com, and I'm publishing a newsletter on the Substack platform that is basically aimed at actionable ideas for what we talked about is coming. In other words, okay, you get that some kind of really disturbing time is coming, but how do you get through it? And there are ideas for doing that run the gamut from lifestyle, personal food production, all the way out to aggressive investment strategies. And so I focus on a lot of that stuff. And so far, so good. The system hasn't broken down yet. So a lot of the strategies haven't worked yet, but laying them all out there so that when the time comes, there will be tools for people to protect themselves and their families from what's coming.
Well, we run a timing model, and our timing model is saying that we're completing. We're looking for things to really start becoming very evident in the next quarter or two, where things really start to become evident, and it's just going to get worse into 26. So these strategies that you're talking about, they can get hold of them, and you have a free newsletter as well, I think.
Well, yeah, the newsletter is available. It has pricing tiers. There's a paywall, but the vast majority of the stuff in the newsletter is free. And then if you want to dig into things like specific portfolios and analyses of individual stocks and shorting strategies and stuff like that, that's behind the paywall. So you can sign up for free and then take a look and see if you think it's worth it to go beyond that.
Well, that'd be great. So can we recap, John, as to what you think is going to happen and how people can protect themselves here? Maybe just like 2 minutes that we have left here.
Yeah. Okay. Very, very brief recap. There's a lot of bad debt out there that's starting to go bad. In other words, losses are being taken on loans that should have never been made in the first place. And that's affecting the banking industry, the insurance industry, the pension funds. And in the coming year, a lot of these losses are going to be reported. And that's going to scare a lot of people. And that's going to cause maybe a banking crisis, maybe a lot of other things to fail. The government's going to have to step in, bail everybody out. That's going to shift the fear over to the dollar and to the other big currencies in the world. And maybe lead to another bout of inflation and maybe an equities bear market. And it's going to impoverish an awful lot of people because for a lot of people, their job is going to be threatened. Their pension is going to be threatened. Their nest egg that they're managing is not going to do well. So it could be a triple whammy for a lot of people. And we need to think about how to protect ourselves from something like that. And there are lots of ways to do it.
Well, I think that's really good. So at the moment, probably the best thing is just to raise cash. Just kind of be a little conservative and maybe start nibbling at some of these proactive things. I love your idea of shorting some of the industries that are going to be at risk. For me, it looks like we got a 2008 on steroids because there was so much liquidity that was put into the market. That's just me. I'm such a conservative guy.
Well, it's correct to say that things are much worse now than they were in 2007. And one of the quick ways to protect yourself from stuff like what's coming is buy gold and silver. You can now buy silver coins and gold coins online at Costco and Walmart.com. I just did that the other day as an experiment to see how easy it is to do. It was like buying anything else on Walmart.com, and they ship it to you, and that's that. So you can start by protecting the basis of your financial life, which is the dollars in your bank account and stuff like that, by shifting some of those dollars into gold and silver, which are older forms of money that tend to do well in currency crises. So that's a place to start. And then from there, there's all kinds of other things to do.
Well, John, thank you so much. We're going to have to do this again because we don't get an opportunity to speak with someone that's as wired in as you are. So thank you so very much for coming with us. Any thoughts that you'd like to share before we go?
Yeah, thanks, Michael. Yeah, one thing, we talked about so much gloom and doom here, all these horrible things that are happening. But if you look at this as an investment thesis, in other words, okay, this stuff is coming. How can I protect my family and maybe get rich from the things that are likely to happen in the next few years? And psychologically, it doesn't change what's coming, but it changes your outlook on it, because you're trying for something that is actually a very good thing for you. And that's psychologically way more helpful than walking around thinking about all the bad things that can happen. So, making an investment thesis, and this can almost, not completely, but almost, be a fun process in the next few years.
Thank you so very much for being with us today. And I want to do the best we can for you. If we can help you in any way, let us know. My best to you.
Thanks, Michael. Appreciate it.